Welcome to EDHEC-Risk Intitute. We're going to discuss hedge funds versus alternative betas. Hedge funds is not something new, so I think we have to go back to some historical perspectives on hedge funds and in particular historical success of the hedge fund industry. This was essentially started in the 30s with the first hedge funds of Carl Carsten and later on in the 40s by Alfred Winslow Jones, and these were essentially about generating alpha and hedging beta. Then later on, the successive hedge funds shifted towards George Soros and Gillian Robertson. They were generating alpha by timing beta, by predicting what markets were going to do and taking positions accordingly. Finally, more recently, in the 80s, the arbitrage desk at Goldman Sachs under Bob Rubins and a series of his alumni started generating alpha by arbitraging. Again, something new. All these people were part of the success of the early days of the industry. During these days, there was limited data, a large amount of secrecy, not much academic research, which means for many people, hedge funds were generating alpha. Not surprisingly, hedge funds are charging relatively high fees and in particular performance fees. So this convinced thousands of people to migrate from long-only mutual funds to hedge funds and start their own hedge fund. However, we have to understand that by definition, alpha is a zero-sum game. There is not an unlimited supply of alpha. If you want to extract it, first of all, it's difficult. Second, you need to find it from someone that has a negative alpha. And it is not scalable, so you can't size it up as much as you want. Betas, by contrast, are in almost unlimited supply. There is a lot of betas available. There's also no limit to the exposure you can get. So many hedge funds have started living on betas. Now, databases have developed, databases about hedge funds, academic research, and the result is the new paradigm, that is hedge funds, or more specifically the hedge fund industry, is generating a lot of betas. Now, initially, beta meant equity market exposure. This is in line with the early works of Markowitz and Sharpe, where the first beta were actually beta to equity markets. Today, betas, there are lots of betas. Some are static, simple, some are dynamic, complex. In any case, they're all systematic and they're all replicable. Let's go for a few examples. Value or growth. These are the old betas, I would say, from the 70s, developed by Fama and French. Quality. Quality companies outperform. You can get exposure to quality companies as a beta. Low volatility. It's been discovered since the 80s that low volatility companies outperform. This is a new style again in betas. Small size. Momentum, trend following. The idea that what has performed well will continue to perform well, and you can get exposure to that. Carry trades, where you borrow cheap and essentially invest at a higher interest rate. Merger, convertible arbitrage, these are hedge fund strategies, but they can also be replicated by a systematic beta. You just go out and invest in any merger that is announced. You just go out and arbitrage any convert that is being issued. Distressed securities investing. Whenever a company goes bankrupt, you can get some of its debt and get exposure to it, etc. Selling volatility. There are many other betas we could discuss here. Now, alternative betas regroup all those betas and they allow investors to access the systematic component of hedge fund strategies in a cheap, liquid, and transparent form. No need to pay the high fees of hedge funds, no need to suffer from the lockup and liquidity restrictions, no need to query and keep wondering what hedge funds are doing. Paying 2 and 20, which are the usual hedge fund fees, to get beta in hedge funds makes no sense. However, before we start replacing hedge funds by alternative betas, one should answer several important questions. The first one is, we might replicate the hedge fund industry. But is that a compelling investment? There are 10,000 hedge fund managers out there. Are they all very good? If we replicate them, the answer should be yes. Do investors understand that they won't be able to replicate the alpha of their favorite hedge fund managers? We are replicating the betas. I mean, keep in mind, hedge funds started as an alpha offering. Are investors aware that lots of new alternative betas have been successful only on an in-sample pro forma simulated basis? There's a lot of alternative betas that have been structured following thousands of hours of simulations. Hundreds and hundreds have failed, and ultimately one has been successful. But this is purely backward-looking. Not sure it will be successful forward-looking. Finally, finding ex post beta is easy. Whatever you do, there is beta. If you just buy one stock, it has beta. It is finding ex ante beta that matters. If you want to replicate what a manager will do, it is the future beta of the manager that you need to analyze, not the past ones. And probably the most important of all questions, with all systematic strategies, who will drive the bus when an issue arises? It is great to replicate beta or alternative betas, but what if this beta starts having a negative return? What will you do? What if it stops working? Who will stop the bus? Today, why do we still invest in hedge funds? I think there are a few reasons. The first one is to gain exposure to, let's call them alternative asset classes, alternative to the usual equity and bonds. And, of course, their risk premium. For instance, commodities, or foreign exchange, emerging markets, maybe distressed securities. All these provide some exposure which can be captured by alternative betas to some extent. To gain exposure to alternative asset management techniques, and here I'm thinking in particular of the short side of the market, the ability to short stocks and profit from the downside, or to put on relative value trades, one instrument versus another. Third reason is to allocate capital dynamically across various opportunities, and there are two ways of doing it. One is tactical asset allocation, which is a forward-looking view, and one is risk management, which may be backward reacting or forward-looking, anticipating. Hedge funds have been very good at doing this. And ultimately, I think the reason for still investing in hedge fund is to manage the risk of our wealth path. And there are two models I'd like to quote here. One is Warren Buffett, famous stock picker. The second one is Alfred Jones, famous hedge fund manager. Warren Buffett only thinks about the growth of his capital, but can tolerate a huge amount of volatility. Alfred Jones also wants to grow his capital, but cares a lot about the path and the volatility along the path. If you want to manage your path, you should follow Alfred Jones and hedge funds. If you want to just grow your wealth, Warren Buffett is probably a better approach. Now, how many managers in our portfolio? This is an interesting point. We typically invest to 15 to 20 managers to avoid diversification. Too many people doing the same thing will only bring negative results and negative alpha, in our opinion. I think the same should apply to alternative betas. There's not hundreds of valid alternative betas. One needs to choose a few and avoid diversification of those betas. So, in my opinion, it is a fundamental misconception to think that hedge funds are no longer capable of adding value. I think they can add value, some can add value. The problem is finding the right ones. Alternative betas can offer a source of potentially uncorrelated return stream to traditional equity and bond betas. This is definitely an interesting field to be explored for traditional investors. New returns, new type of returns, uncorrelated, potentially positive, that remains to be seen. Alternative betas are not a replacement for the best hedge funds, but they're definitely a threat to the mediocre ones, and there is a lot of them. As usual, I would say the devil is in the details. They're good and bad quality alternative betas. Being selective, allocating to the right ones, and doing it with the right timing will be key for success.